repairs, maintenance, and extraordinary repairs. This video explains the difference between ordinary repairs and extraordinary repairs. Many of long-term assets require repairs and maintenance each now and then. Repairs could be classified into two types: ordinary repairs and extraordinary repairs. Let's speak about the ordinary repairs. A company has a truck. The truck is regularly used. However, after a while, it will need some maintenance and repairs. Repairs and maintenance are done to the truck, such as changing of sparks, filters, oil, etc. Repairs could even extend to changing tires or swap winter tires, etc. All these are ordinary repairs. You will notice that they are recurring each now and then, and they are necessary to keep the asset operating. Ordinary repairs are expensed in the period in which they incur. This is done by debiting the repair or maintenance expense account and crediting cash or accounts payable by the amount paid. Assume it is $500 in this case. Now, what if the truck was working for some time and then it stopped working totally? It is taken to the workshop. They found that the motor must be replaced with a new one. The old motor is replaced with a new motor. You will notice that after a new motor is used, the total useful life of the truck is extended, provided that the truck's body is in good shape. Such repair is identified as an extraordinary repair, which is like an overhaul of the asset. Accordingly, there is a rationale to capitalize the cost of such repair. In other words, the cost of such repairs is added to the cost of the asset, which is the truck. This is done by debiting the truck account and crediting the cash or accounts payable with the value of such repair. Let's assume that it is $5,000 in this case. Let's take the following example. A company bought a truck for $120,000, salvage value $20,000, and useful life is 4 years. The company uses the straight line depreciation method. By calculating the annual depreciation, and that is by subtracting the salvage value from the cost of the asset and dividing it by the useful life, we get $25,000 per year. Let us further assume that the company used the truck for the first 3 years. At the third year, the truck broke down and required a new motor, which costs $17,000. The cost of the new motor is added to the cost of the truck, so the total truck's cost is $137,000. The installation of the new motor will extend the life of the truck an additional 2 years. So the truck will be working for another 3 years in total. Let us calculate the accumulated depreciation at the third year. Remember that we calculated the annual depreciation of the truck and it is equals to $25,000. So the accumulated depreciation will be equal to $25,000 times 3 years, so it's going to be equal to $75,000. Accordingly, the net book value of the truck is calculated by subtracting accumulated depreciation in year 3, which is $75,000, from the updated cost of the truck of $137,000. So it is equal to $62,000. If we subtracted the salvage value, which is $20,000, then the new depreciable amount will be equal to $42,000. Dividing the updated depreciable amount, which is $42,000, by the updated useful life of 3 years, the depreciation expense for each of the following 3 years starting from year 4 is equal to $14,000 and will be recorded by debiting depreciation expense of $14,000 and crediting the accumulated depreciation for the same amount.